Thank you all for being here. We're going to go ahead and get started. And so I'm going to turn it over to Education Credit Union and Colton, and he can announce all the names correctly and titles and all that good stuff. So, and if you're on virtually, just if y'all have questions, just type them in the chat and make sure that you put your Buff ID in the chat if you're on virtually. So.
Good afternoon, everyone, and happy to be back here for the second week of Advanced Money Management Bootcamp. As you said, my name is Colton. I'm from Education Credit Union, and fortunately, you're not going to hear me talk for about 45 minutes. You're going to hear the most qualified person to talk about home buying, car buying, and large purchases, and that is our mortgage director. So Brittany Aguirre is our mortgage director. She oversees the entire team that hosts mortgage loans at Education Credit Union. From our team members down in Dallas to our local here team members. She's everywhere, does all the things. So I'm so excited for you to benefit from her wisdom. I'm going to chime in, ask questions, but she is just as fun and welcoming as I am. She loves questions. So if you have them, raise your hand. She'll answer. She's been with us, how long have you been in education?
3 years.
3 years, but 10 years in the mortgage business.
I've been in banking since I was 19. I'm in my 30s. So I have done banking through that whole time, but mortgage about 8 years. So I've worked banks, credit unions, so I like to be a professional. I don't know it all, but I'll find out for you.
Very cool, please. All right, so the financial institution professional is here. Please welcome Brittany Aguirre. There we go. Thank you so much.
Well, thank you guys for being here. If I don't turn this way, I'm sorry, I'm blinded, so I'm not hating on this side of the room. It's just in my face. So thank you for being here. I hope that you leave today with just an idea if you are ready to buy a house or not. And if you're not, that's okay, but you'll have the tools to kind of know where to start to hopefully get there. I would like to say I want this to be interactive, so please, as I'm going through, if you have a question, raise your hand, let's talk about it in that moment. Sometimes when we get to the end, we forget, and I would rather you guys just interrupt me at any time and let me know if you have a question about something. So again, I have done this for quite some time. Home buying is kind of a passionate thing that I like to do. I love my job, which is kind of weird because it wasn't where I pictured myself when I was in college and your age. So I am really excited to kind of just give you guys some tips today. So first thing I want to do is I also want to tell you kind of a personal story from myself. And I'm kind of blocking you, Colton. There we go. I kind of want to just give you a personal story. So my husband and I, we've been married 9 years. We were college students once like you. I was a broke college student, and I was not ready to buy a house back then. And so we got married, and we got the pressure of when are you going to have kids? When are you going to buy a house? When are you going to buy a new car, right? Like all the things, I'm sure we've all heard this. And so we kind of started thinking, well, maybe we should buy a house. Maybe we should go and do all the things. So I had just started my career here in Amarillo. I'm actually from Oklahoma. And I moved here, and I was at Amarillo National Bank, and I had just started as a receptionist in mortgage. So I really didn't know anything about large purchases either. I had never bought a new car. I always had a used car. So again, I fell to the pressure of let's do this. And I didn't have anything prepared yet. So we go, again, I was working in that business. So I went and asked the loan officer and I said, okay, I want to buy a house. It's $260,000 back in 2016, which was quite a bit back then, especially for a first time home buyer. But I thought, well, I can do it. I have a good career. I just started, like we could do this, right? No, I was very quickly told no. So again, I was not prepared to do, and I didn't know all the ins and outs of what comes to buying a mortgage or a large purchase, even like a car, right? So fast forward to 2 years ago, after all of these years, my husband and I started to do a budget. We started to prepare. We started talking to the right people, professionals like Colton.
You know, you just said the word budget, which is one of my favorite words.
Yes.
And so I know, you've heard me before, love it. But I just want to reiterate, because that was the key to sort of you, again, even working at a financial institution, even being part of that community, it's that foundational tool. Last week we talked about building credit, but having a budget, that fundamental thing, is sort of what set you on this path.
Exactly. And so I just needed guidance. And so somebody like Colton, I didn't have a Colton back then. My parents did not have good credit. They're great people, but again, they didn't have that guidance either. So use him as my point. Call him. So again, anyways, fast forward. So I prepared. I was taught the things that I needed to know. And 2 years ago, my husband and I were able to buy our first home. And actually, even better, we were able to build our home. And so for me, I say this because patience is everything, right? Don't rush to do it just because maybe there's pressure to do it right now. You're in college, you're about to graduate. What's next? Well, definitely buying a house if you have everything to do it. It doesn't mean you have to. So I actually, the other day, I was on Facebook and Dave Ramsey, I follow him too, and he had a long post that I'm not going to read all of it to you, but he had something that I think would stick out. So renting is not a waste of money. It's buying patience until you're ready to buy a home. So I point that out too, because as we go through this, if you determine at the end of this conversation that you're just not ready to buy a house, that's okay. Patience. That's my biggest piece. You don't get anything from today, take away patience. So.
And I kind of agree with you on that, because not only today, but in a couple of weeks, we're going to talk about investing, and an investment journey is also an exercise in patience. So things like finance, when it's building credit and taking the steps to make payments on time, keep your borrowing balances low, and chip away at that debt mountain, you're going to need patience.
Yep.
When it comes to preparing for a large purchase, you're going to need patience. Next week, we'll talk about dealing with insurance professionals, and yes, we'll absolutely
I won't be here for that.
require patience. But yeah, so patience is a really key thing. So my question, what is the checklist? How do you know when you're ready? What does that look like?
Yes, great question. So I would say you don't really know you're ready until you have the guidance, right? That's why you come and talk to people like me, like Colton. If you've got a realtor friend, whoever it may be, I wasn't ready at your age. So I don't know that I was even ready 2 years ago, but I was prepared. So I want to give you some key things that helped me through my process and what I see today through just working with people. One of the first things is stable income, right? I mean, if you don't have a job with stable income coming in, I'm not going to lend you money. I mean, that's common sense, right? We have to have a job. Now, I don't want this to scare you away, because how many students maybe live at home? They don't have to work right now. They're paying for school, so they don't have any savings, right? They don't have any income necessary because maybe somebody's able to help them. That's okay. You can still qualify for a mortgage. Okay, don't let that scare you away just because you're young and maybe in school, or maybe in your 40s buying your first house and you've got the stable income. We can look at both. Okay, so don't let that scare you away. Something else to keep in mind too on income is like if you're self-employed. So a lot of lenders require 2-year work history if you're self-employed. Okay, my husband is self-employed. This is where we struggled because he didn't have 2 years self-employment yet because we had just started his job.
And self-employed includes things like you have an Etsy shop,
Yep.
are you when you have your own
Yep.
small business, you're trying,
TikTok.
there we go, if you're an influencer of some kind in
Yes.
income, they exist in Amarillo Canyon. You can earn $3,000-$4,000 a month doing YouTube, doing TikTok, so there you go.
And believe it or not, Bitcoin, sometimes you can actually use that to show assets, which that's a whole other conversation. But again, there's guidelines for anything and everything that's out there, okay? Kind of get more into this, but really, credit unions, we have a lot of ability, we have a lot of gray room. So when it comes to your income, I was an underwriter for a long time, which means I was the one that looked over your entire life in one big page and said, yes, they can afford this, or no, they can't, and I would approve or deny it, okay? So I got to see a lot of different scenarios, and I'm able to, at the credit union, do a lot of things that I couldn't do at banks. No hate on banks, they're great too. We just have that gray room where we can really help you. Yes, go ahead.
So were you a mortgage lender during the 2008 financial crisis?
Yes, I was. So, well, during COVID or when?
During 2008, 2009.
Oh, no, I was not. I was not in
You
mortgage.
were fresher faced back then.
I was
but
not.
yes.
I was in banking, but I was not doing mortgage then. I wish I was. I was doing more than. I was, however, during COVID, and that's where a lot of this information comes from, is that I had to get creative. So COVID, we all know, that was a mess anyway. Income was up and down for people, and so I do think that credit unions just have that ability to really dive into a unique situation. So if that's you, keep that in mind too. Okay.
And remind them why we were able to go above and beyond in a credit union. What people perceive as above and beyond.
Yeah, so we're member focused, right? Everything that we do is not just a transactional mindset. We really have your best interest at heart. So, go ahead.
Oh, sorry, I was going to say because I just get all excited.
We are excited.
But because credit unions are member owned.
Yep.
Your member ownership is something that matters. And so, and by law, if we're helping our owner, that's how banks do the same thing, except they're companies, individuals, or wealthy families if you're local. But yeah, like that's the deal.
Yes.
So we get to help our members, just like banks, or help our owners, just like banks do, but our owners are our members.
Yes, and I know we've got a question, I think.
Yes, we have a question from one of our online. What about if you're doing it yourself and not married?
That's a great question. I hope that's girl power up there. You can definitely do it by yourself, and honestly, it's the same thing. If you've got 2 or 1, it doesn't matter. It's the same scenario. Do you have stable income? If you have a couple other things, I'm not going to jump ahead. Same thing. You don't have to have a co-borrower, which is somebody on the loan with you, either a spouse or a parent would be a co-borrower. We can get into that if you guys have more questions on that you can ask do the same thing across the board. Kind of to touch back to what Colton was saying too, kind of credit union. So when we go in and we look at your file, the cool thing about especially Education Credit Union, we're able to really tell you, okay, if it's a no, it's a not right now. It's not a straight no. We help you along the way, get you to a yes. I think that that's super important. My experience being at other big banks prior to the credit union, I couldn't always do that. It was really just transactional. It was kind of like, no, sorry, come back in 6 months. We didn't really help you or give you the tools. That's what this guy's for, and hopefully me too, but that's what he's for.
Well, and that's the other aspect too. Again, banks are really great, especially if you're looking at commercial property or investment properties, things like that. We'll touch on later. But credit unions have those retention tools in their back pocket to sort of help their owners. We operate differently as not-for-profit financial cooperatives. So us being able to have those conversations with you, I'm going to move you. Oh, you talked to Matt, we talked to Brittany, and we're, you're not in a position right now to get a mortgage from ECU. But you know what? We have a financial counseling department if you would like to talk to them, and we can then dive into your situation. And again, it's free, and find that solution for you to where, not right now, but in 6 months, if we adjust this aspect of your budget, or if we get your credit score to this position, you would then qualify for our mortgage. But also, it's building that relationship. Even in 6 months, if, we were shooting for a 650 credit score, but we got you to a 630, that means there's still wiggle room. You've built that relationship with us, and I can go to Brittany and I can say, I've seen them every 2 weeks, every payday in my office. We've adjusted, we've done this. We can then advocate, what we call advocate for our member. And again, go above and beyond, but you're our owner, so we're doing our job.
Yep. Thank you, Colton. Okay, so any questions on income? Can I go deeper in that for you? If you have questions at the end, also feel free to ask. So, okay, next thing that's important is savings, right? I know that's hard right now because the world we live in, eggs are like $30 and nobody has time for that, right? So a savings account is hard, especially coming out of college. What's a savings account? Well, it's important. Again, this is why you plan many years ahead. Remember, whenever I was not qualified for a loan, it's because I had no savings, I had no money other than paycheck to paycheck. Fast forward, we were able to kind of start a savings account. The reason that's important is because it can determine what kind of program you qualify for and what best fits your needs at that time. So, go ahead.
Oh, I was just gonna, because, traditionally, I've always advocated, you've heard me talk about credit and even budgeting. We save to reach our goals. That's what budgeting is designed to help you save. That's the whole point of a budget, is to help you save money. And when we talk credit, I remind people, because sometimes people think that their savings amount has something to do with their credit score, and that is not the case. But when it comes to a lending decision, what you have in terms of assets, again, just like you said, is we're about to go into, it determines what other programs or other benefits that you might qualify for. And with that conversation that will come with, you qualify for X amount of house, but then when we really look at the loan, should you be getting that much house?
Exactly. And so that's where we play the part as lender, and we hopefully are counseling you to determine which product fits you best. So I am always going to recommend from the start a conventional loan. A conventional loan is an in-house product that pretty much every lender, at least in Texas, offers a conventional loan. We do not sell this to the secondary market, which means when you call, you talk to us. You don't have to call Truist or some other investor that is in Dallas or Chicago or some big thing, right? We keep it in-house and we don't sell it.
When it comes to selling loans, that's something that was a surprise to me as a first-time home buyer when I purchased my first home. Within 2 months of me getting my home loan from my lender at the time, they sold my loan. So there are companies that actually will purchase loans from banks, from financial institutions, credit unions, and then monitor and operate those loans themselves. They will purchase them from. So, and then we will sell that loan, get that income, and they'll earn income from the interest and all that stuff from that original loan. A lot of people find it challenging when their loan has been sold to a company that they don't know. It makes it very difficult to get in touch with a customer service person. Are you being charged the appropriate interest rate? Did you made your payment, but there's something that's not showing up on a statement? Having a loan that's local, that you can walk into somebody's office and ask and get an answer to your question we found pretty important.
Yeah, and another piece of that is, like Colton was explaining, when we sell that loan, I have to choose that interest rate based off their interest rates. I can't choose it based off ECUs. So from the start, I have less control over this file to potentially help our community and help you get the best bet for yourself. I can't do that in the secondary. Not to say those options are bad, right? They're fine, they're great, they're there for people who need them, but I'm always gonna recommend a conventional loan because I think it's the best place to start. Second part of conventional loans is, let's talk about the down payment percentage, okay? So minimum across the board is usually 5% down payment is the requirement. That's across the board with any lender. There are options for first-time home buyers, 3.5%, 3%, depends on what that lender offers, but there's first-time home buyer programs that are 3% down. But this is where savings comes into play. So the more you save, the goal should be at least 20% down or more, because then it puts you in a whole different bracket to where your payment is lower because you won't have private mortgage insurance, okay? So I'll talk about the other down payment in a minute, but let's talk about private mortgage insurance, because this is kind of a big deal between products too. Did you have anything before I chime into that?
No, you get
Are
into
you sure?
private emergency.
Okay.
Good thing.
Got it. So private mortgage insurance, who knows what this is? Out of curiosity, anybody know what private mortgage insurance is? You ever heard of it? Great, then I'm here to tell you. So, okay, so insurance, you think, okay, my homeowner's insurance. You guys have to get it covered in case something happens to your house. This is not that. This is for us as the lender. So we go in and we say, if you are at a loan to value, which technical, but when you're at a loan to value of 80% or more, which means you don't put 20% down, you put less than that, I am now saying, okay, you're a higher risk. I need to make sure that we're secured, so I'm going to go make you get private mortgage insurance to cover in case you default or if you foreclose. That insurance covers us as the lender, okay? So that payment is, I don't know the percentage, but it's like 50% of your payment. It's a lot, right? So instead of getting a $300 P&I payment, now you're going to have a $500 payment. Well, that's a really low number, but that's just an example, right? So it's a huge part of that payment. So if you can save and potentially not have private mortgage insurance, do it. That's why I say start now, saving, saving, saving.
No, I think we might have it on a future
That's
slide,
fine.
but
Sure.
just to move it there, saying it twice, you can just come across it again. So say, I've tried to save, I say part 20%, but I'm gonna get a gift. I'm gonna graduate, and that's gonna be my graduation present from grandma so-and-so.
Yep.
And I'll have enough money for a down payment for a house. Can I use gifted money?
Absolutely. So this is a little technical. I'm not going to go all through the ins and outs, but you can absolutely use a gift. There's specifics on guidelines as to who can be your gift donor. Usually if it's a family member, even a fiance, a grandparent. I'm not sure that friend is always on the list, but if it's a relative, you can absolutely get a gift, and that can go towards your down payment or your closing costs. So next part of this, did you know that you have to pay closing cost and down payment when you buy a house? You guys know that? Okay, a lot of people, you'd be surprised, a lot of people don't understand that, and that's okay, but you have two different things. So when I say, okay, you're gonna come get a loan and your minimum down payment is 5%, you're gonna calculate that and figure out, okay, well, that's all I have to bring to the closing table. No, you gotta pay another 15 to 20,000, give or take, in closing costs, okay? Now, don't let that number scare you. There's programs out there that help with this.
And you can even negotiate with the seller, depending on how long the house has been on the market, for them to take on.
Exactly. So kind of two parts there. So this is why it's important to shop around lenders, ask them what their closing cost fees are and compare. So I can tell you my closing costs at ECU, I watch this on a regular and I know that mine are lower than most lenders in Amarillo. And we do that on purpose because again, members, credit union, we want the best for you, right? So always shop it. Yeah, go ahead.
Does shopping comparing for your credit score?
No, good question. Now, if they go pull your credit, that's a whole different story. So that's when you actually go apply. Now, some lenders may make you apply before they'll give you information. So you do have to be careful. But I will say if you go to one lender and you have them pull your credit and then let's say 3 days later you go somewhere else, you typically have a 30-day spread where it's only going to be one hard pull on your actual credit. I'm marketing director. So again, you have it where it'll just hit you one time, but I would always recommend, like, if you were to call me and say, hey, will you just look at my debt to income for me without pulling credit, we'll do it for you. So just, you have options and you have a voice and you can absolutely request that. Go ahead.
So if I'm calling, because I didn't do this, I wish I had.
Yeah.
But if I'm calling and I call AB and I call ECU and I call Access, and do I just ask to speak to somebody in the mortgage department and say, hey, I was told that, you have really great closing costs, I'm looking at purchasing a home and maybe financing would go, will they be able to sort of give me a ballpark figure of what their closing costs typically are?
Yes, so I would recommend you ask for a closing cost worksheet. That's usually the term that's used. I worked at A&B, that's how we said it, that's how we call it at ECU. And
Closing cost
yeah,
worksheet?
Closing cost worksheet. What that's gonna show you is a breakdown based off the scenario that you give them. So if your potential is to buy a $250,000 house or a $100,000 house, they can break all of that down for you based off the percentage that you're putting down, and they will actually send you a closing cost, and at the bottom line, it will tell you, okay, on average or on estimate, this is what you're gonna have to bring to the closing table. That will also give you an idea of, okay, how can I negotiate with the seller to get seller credits? Because I know my portion is altogether, let's say 20,000. Okay, well, I'm gonna negotiate, if I go offer the asking price on this house, I want $10,000 in closing costs from the seller, right? So those numbers are important. If a realtor comes in though, or even a lender, we can help you kind of negotiate that. Closing costs also, you can compare fees for lenders. Now, there's certain fees across the board, like an appraisal. You're gonna have to get an appraisal when you're buying a house. Usually that's an average of $500 to $600. So you are responsible for that, but again, it's all in that bottom line number that you bring to the closing table. Any questions on that before we move on? Did I miss anything you wanted to touch? Okay, so again, that's why savings is important. Let's kind of move on to FHA now. So we touched on conventional. FHA, so that stands for Federal Housing Administration loans. So these are government loans. That's how I put it. There's lots of options through these. You can do adjustable down payments. You can do 2 1-arms, 10 1-arms. You can do all these things. Do I need to say something?
You can tell them what adjustable.
Yes, I was about to do that. Okay, I was about to do that. Okay, so let me back up. So conventional, that is a fixed rate, okay? That means it doesn't change the whole entire life of the loan. You can do term 10, 15, 20, 30 years. Most of the time, first-time home buyers are doing a 30-year. I always recommend that because you have a lower payment, but if you can actually afford more, pay more, there's no penalty to pay a mortgage early, okay? When you do FHA, the benefit versus a conventional is it is a lower down payment option if you're not a first-time home buyer, which is 3%. You can do FHA and it's 3.5%, but you're gonna have that PMI and you're gonna have it the entire life of that loan. So if you never refi for 30 years, that's never falling off. Whereas on a conventional, let's say you put less than 20% down and we do put that PMI on your payment, it will fall off once you hit 80%. So once you pay 20% of that loan down, it'll fall off. It's gonna save you money. FHA is also, again, it's government, so there's a lot more to it. They want a lot more documentation for those loans. It can take a little bit longer to get qualified, so if you're in a hurry, it's not a bad product at all. I would say the reason I would go FHA is if you've got a lower credit score, if you need a little bit less down because you just don't have that savings. But my recommendation would be get in the house with an FHA with the mindset to work on credit so that in 2 or 3 years you can refinance. Within that first 5 years, if you don't refi, you can catch up on your payment. I mean, you can afford it if you start with a decent loan amount, but I just always recommend try to refinance out of those because they're good to get you in the house, but your payment, you're paying more than really what you could if you would have had some savings ahead of time, okay? VA, is that on here?
It is not on.
Okay, well, just so everyone, because we've got some veterans in here. So we have veteran loans, VA loans. You can get in the house potentially 100% finance, so pretty much 0% down. They kind of follow the same thing as FHA. There's a lot. We have to get your, what's it called, certificate of.
That you can buy it.
Your certificate, basically your proof that you have, you are a vet and that you can get into this house based off the veteran affairs that they're allowing you and you don't already have a loan. So you can only have one of those at one time, okay? So again, that could be 0% down. You don't actually have to carry PMI on those. So those are really great products. It's just, again, it's only if you're a veteran. So make sure, yes, go ahead.
What if you're not a veteran, but you do have a traumatic brain injury?
Interesting.
So in that instance, you would still, you wouldn't qualify for anything VA related or veteran related, but there still could be programs and things in your state. There's actually a web, TSAHC.org.
It's TSHAC.
TSHAC, there it is, yes.
TSHAC, TSAHC.
Yes.
So thank you for bringing that up. So that reminded me. So when we talk about programs, again, you've got conventional FHA, VA. Those are kind of your 3 typical loans. Within those loans, that's where you have other down payment assistant programs, okay? So, for instance, TSHAC. I don't offer TSHAC, but I know what TSHAC is. We have Homes for Heroes. So it's all dependent on what line of work are you in.
Or do you qualify another way?
Yeah,
So-
exactly. It just depends. There's a million products out there. It's just, again, this is why I say shop around lenders, because for whatever you're looking for, they'll have an answer. We have one that's called the Help Funds. So potentially this is open to anyone who's a first-time home buyer. You could potentially get up to $20,000 in a grant that you never have to pay back, that goes towards closing costs and down payment system, or down payment, I'm sorry. There are income limits on that. So again, there's qualifications you have to abide by, but there's lots of products out there. Okay, talk about gift funds, retirement accounts. Let's touch on that real quick. So you can use retirement funds for down payment. You can actually use retirement funds for income. Know that? You would know that? Great.
There's an
So
interest penalty though.
not always. So if you pull from it, yes, there is. There is something that's called asset depletion. So when I was an underwriter, this was like during COVID, this helped a lot of people. So let's say you've got income, but you just don't quite qualify, but you've got a big 401k, you haven't touched it, right? You've started like me. I was 19 when I started my 401k, so I've built it up. So if I potentially have 20% more in that account than what I need for closing, I don't have to liquidate it. All I have to do is show proof that I have this money in an account, and then depending on the term of your loan, I can do a little transaction and determine, okay, monthly, if they were to lose their job, they could potentially pull $1,200 out of for income monthly for the next 20 to 30 years. I can use that as income to help you qualify, which is really cool because that actually has really helped some buyers get into their homes. Now you have to be careful with that because kind of like we were talking about earlier, we have your best interest at heart. So that's why it's important to really know your lender because we don't want to set you up for failure from the beginning. If you can't qualify, we're going to use retirement to get you in a house that I wanted at $350 when really I could only afford $100,000. That's not setting you up for success, right? So that's why it's important to kind of think that through, but you can use them if you need them. Okay, before I go there, let's kind of finish up talking about just some things that can help you become ready to buy a house. Credit score. I know you guys talked about that last week, right?
Yes.
You guys went through that, so I'm not going to make you go through that again. Credit is super important, obviously, when you do any large purchase. When you buy a car, when you buy a house, your credit score is important. Personal experience, I had horrible credit coming out of college. I won't get into why, but I had horrible credit. So I also didn't have anyone teaching me these things. My parents didn't have great credit. So learning now, what I wish I would have known then is don't get a bunch of credit cards. But no, we all probably have student loans, right? So it's okay if you don't have super great credit yet. There's options for you. Conventional, bottom line 620 is what we're looking for. Now, if you're below that, again, credit unions, some banks, we have that gray where we may have in-house products that we can still help you if you're below that. But usually that's your minimum credit score is 620. FHA, I meant to look this up. I think it's actually 590 now. I think it used to be 580, but that's the minimum credit score, so it actually is lower than what your conventional would be. That's why I say to get you in the house, FHA might be the way to go. So if you have no credit at all, we do have guidelines for that too. So a lot of times what we'll ask for is maybe a VOR, which is a verification of rent, just to show, hey, they made their payments on time for rent. There's ways for us to prove that, okay, we think they're a low risk, they're going to pay us back, even if you don't have credit history, okay? Any questions on credit there? What did you learn last week? Just kidding. Did you have something? Yes, that's where we're going. Okay, debt to income. Anybody know what that is? Yeah, go ahead.
The ratio of how much revolving debt you have
Yes, great
to
job.
how much you're bringing in.
Yes, so do you guys know how to calculate your own debt to income ratio? Great, we're going to do it right now. You said no. Okay, so do me a favor, if you would, if you're interested, pull out your phone, get your calculator out, write it on paper. What I want you guys to do is I want you to think of every payment that you have reporting to credit right now. So a credit card, a car loan, maybe you've got student debt. Think about what all those payments add up to. You can guesstimate. Say whatever, maybe 2,000, whatever. So write that number down. Once you do that, I want you to guess what you think a payment would be on a house that you would potentially want to go buy right now. Would it be $1,800? Would it be $2,500? $900? Whatever you think that is, add it to the number that you just calculated for your payments. Okay? Now, if I go too fast, let me know. Once you've done that, I want you to take that number and I want you to divide it by your monthly gross income amount. If you have one, if not, just make it. Okay? Anyone have that? Does it give you a percentage? Okay. Tell me what your percentages are. What's yours?
0.4.
0.4, okay. Anyone online have they answered? I don't know if they've answered, but who else? What's your percentage?
4.47.
Okay, so 44, so that would have been 40. Okay. On average, what I'm looking for as a lender when you come in and ask for a loan is 43% or below. Okay? This is because that debt to income ratio tells me if you're living outside your means. If you are at 50%, 70%, I'm not lending you money. Now, if you're at 50, you've got something going on, we'll talk about it. If you're at 70%, it's a no. We got to send you to Colton. You need a budget.
And I'm gonna ask you, like, is something else in your name? Are you, somebody else having this responsibility? We're trying to get that debt to income ratio down.
Yes. So debt to income ratio can also determine what loan type you get. Some conventional loans, they will not let you go over a certain percent. We have a system that we run it through. I won't get into that, but basically, long story short, it'll say yes or no. So debt to income is really important. So always, now that you have that calculation, pay attention to that. As you kind of get into your careers and as you start making more money, start spending more money sometimes. That was me, hence to why it took me a long time to buy a house. I had to change my spending habits. Okay. So again, debt to income is super, super important. Long-term commitments too, so really on average, this may be different now, but whenever I first was in mortgage, 3 to 5 years on average is kind of what people were staying in their homes. Might be a little bit longer now just because our rate environment's a lot higher than what it was back then. But on average, usually first-time home buyers stay in that house 3 to 5 years. So adjustable rates, get back to that because that kind of has something to do with this. A lot of times you will have lenders that will offer what's called an ARM. That is a adjustable rate. That means your rate is not going to stay the same. Now, if it's like a 2-1 ARM, it will stay that way for 2 years, and then it's going to adjust every year. 10-1 ARM, same thing, okay? First year it stays, the next 2 years it changes. It just depends, right? That's just how it is. Go ahead.
So, what are there any benefits to maybe taking when it's fixed, a rate like that when it's fixed, and paying off once it gets to adjustable?
So
usually, paying it off while it's fixed before it goes to adjustable, if you can, is great. Like if you have a 10-1 fix and your payment is fixed for 10 years and then after that it will change every year, then yeah, if you can pay off your house in 10 years, let's be friends.
So
But
actually to that, it's actually fixed 1 year and then it changes for the next.
There we go.
So if you can pay it off in 1 year, kudos to you. You probably could pay cash for that house, right?
Right.
So yes, there's benefits, but I would say these products are, again, really good to get you in the house, but you have to have a plan to maybe refinance because adjustable ARMs, we have HELOCs, which are home equity line of credit. I see how those payments they eat up an interest. So just be careful. They're great products to get you in the house, but again, just be mindful of that.
And when it comes to refinancing a home, it's a little different than refinancing like a car purchase where you can just take it to your preferred lender. Like you don't like how this car dealership treated you, you can take your car loan and take it to your bank or credit union of choice. And it's pretty simple.
Yep.
But when it comes to refinancing a home.
Yeah, so when you refinance a home, it's also a longer process.
It is a longer process.
Usually, so once you get into the house, you can refi at any time. Once you do one refi, a home equity loan is what that's called, or a Texas cash out refi, you have to wait a whole nother year before you can refi again.
And there could be closing costs.
Yes, there is closing costs, thank you. There is closing cost again. Now they're a little bit cheaper than when you first bought the house, but again, we're gonna charge you an origination fee because we're originating this loan for you. That's how we make money on the lending side. You may have to pay for an appraisal again. There could be lots of fees, but they are cheaper, yes. Now, here's something that I wanna point out too, which I'm skipping ahead, but there's something that's called a loan modification. And I'm proud of this product because ECU does it a little bit different than most places. Loan modifications are usually used if you're kind of in a spot where maybe you lost your job, you just can't make that payment right now, or disasters happen, you need help, right? We can look at loan modifications and help you out. What ECU does is we don't care if it's a disaster or something's going on. If the rates are down and your credit is up, instead of you having to come in to do a full-on refinance, we'll modify your loan for you and we won't charge you anything except for $500. That's it. So again, you don't get money back if you do it that way. You can't take somebody off title or add them on. That's a full refi. But if you just want to modify because the rates went down and your credit's better, we can do that for you. Okay?
So imagine the illustration that we received, saw the T
Yeah.
numbers was, during COVID, was pre-COVID, they might have gotten into a house in 2016, 2017 at like 5-6% interest. And then COVID happened and, oh my God, 3%.
Yeah.
And you can cut your interest rate in half 3 years into your loan.
Yeah.
Resulting in, and we do loan modifications rather than going through the whole refinance process. So it helped a lot of people.
It is really great. And I will say, just based off the rate environment right now, I know it can seem scary right now because rates to us, being the younger generation, oh my gosh, these are so high. Well, talk to my grandparents and they're like, no, they're not. Way back when they bought their house, it was 10%, 13%. We're back to normal. We're just not going to see COVID numbers. And I think we're kind of that generation that's a little bit, and yes, I'm including myself in your generation, we're a little used to seeing COVID and lower rates. We're not going to see those for a long time. So don't let it scare you, the rate environment we're in. That's why things like this are important, so you know your options when you go into the process of buying a house. Okay, so let's talk a little bit about earnest money versus option money. So let's say you've got a realtor, you're in the process of buying a house, you're in contract, or you're about to go under contract with the seller. You are going to hear the word earnest money. Well, I'm not going to ask you, but earnest money is money that shows you're interested in the property. Option money is money that guarantees your option period. So basically what that means is you're going to take, let's say, $1,000 and you're going to say, okay, here's my earnest money. You cannot offer this house to anyone else during this period because I'm interested. Here's your money. Now, if I back out, they get to keep my $1,000. If they back out, I get my money back. Now, if you make it to the closing table, you get that money back either way. Okay, you're just securing your deposit basically for that house. Option money is usually $100, $200. That is going to be, you pay it with your earnest money, but you're going to set a date. Okay, I have 12 days to go in and do any inspections I want to do really anything that you need to do to make sure this is actually the house you want. You have 12 days to do that. And if you back out of that, they get that money versus if you don't back out, you get it back at closing. Okay, so it's one and the same. It's just, this is just more kind of you're setting the date to do inspections. And if they don't fix those inspections for you in that time, then you can potentially leave that contract without having to pay a fee. Questions there? Okay. Here we go. Escrow analysis. Okay. Escrow analysis. So taxes and insurance estimated for the year and added to your principal and interest for your total mortgage payment. So when I talk about debt to income ratio and all that, I am also including your escrow, not just your principal and interest. So when you did your debt to income ratio, that $1,800, $2,000 payment, in my mind, that's including taxes and insurance. Okay. So every year, or whenever you buy a house, with every monthly payment you make, a portion of that is going into what's called your escrow account. Basically, I like to say it's a savings account that you can't touch, but we can, to pay your taxes and insurance at the end of the year. Now, escrow can get a little bit tricky sometimes, especially after the first year that you've been in the property, because the first year, we're in charge of it, we've collected up front. Sellers' prorated taxes get paid, so you're only paying the portion. Let's say you buy a house in October. The seller is responsible for paying at closing January to October, and then you would be responsible October to December. It's all collected up front in those closing costs that I was talking about, and we pay that out. Now the next year, let's say your taxes or your insurance, they go up. Well, we always, ECU and most lenders, we require what's called a cushion in this escrow account. So we're going to require 2 months extra to ensure that you have enough funds in case something goes up. But we can never give you that, like you can never not have a cushion in your escrow account. So it's always got to be there. This is where things get complicated when we tell you that your payment's going up because of escrow analysis, which I don't know if y'all heard of this, but escrow analysis is something that we do every year one time. So we are basically going to go in and we are going to analyze your account. So let's say we estimated for $1,000 in taxes, but really it was $1,200. Well, now you're $200 short. Well, we're going to pay it out for you because you have that cushion. But now you're responsible for making up that difference going forward. And Now your payment goes up because now if you're not gonna be short next year, I have to account for those $200 extra because you're gonna be short next year if I don't. Does that make sense?
It's kind of like a lawyer holding fee.
Yeah. So again, a lot of people get confused with that, and sometimes they come and yell at me because they don't understand. Well, if I pay the difference on what's due, why is my payment still going up? Well, because now if I don't up your payment now, next year you're gonna be in the same boat but double. You're gonna be even shorter. Okay, so just, there's a lot more into that. If you have more questions, I'm happy to answer them after, but just analysis.
Well, and that's also a good reason sort of not to hit the ceiling on what you're allowed to borrow when it comes to house shopping. Because if it's barely what you're able to afford now, if it's the ceiling of whatever your perceived budget is, your house payment is not going to go down. It will go up, only up.
Yep.
So if you're just barely making it now, think 2, 3, 5 years down the road, are you still going to be barely making it? Because we can guarantee that your payment will go up, some way, shape, form, or fashion. Property taxes will increase, all that stuff. But you guarantee a raise or an income to match whatever it's going to cost you.
Yep.
There you go.
And there's something you can self-escrow, that is a thing. So if you don't want us to handle your escrow, we will allow you to actually handle it yourself. If you're responsible with your money and you know you're gonna put that aside to pay it, by all means do it. Sometimes it's even better, you don't have to deal with us in escrow analysis. You don't have to deal with your payment ever changing. So again, I can kind of give you tips on that too, but. Okay, so before we get into buying a car, really the last things to ask yourself is, what is my budget? How much can I afford? Have I factored in property taxes, insurance, and maintenance, and what type of mortgage is best for me? I mean, guys, really, it's just be prepared and be patient. Those are the two main things I want you to take from today. Y'all are at just a transitional point in life, and I was there. We've all been there before. It's exciting, but just be prepared and utilize us if we can ever help with mortgage questions. We're happy to.
Absolutely. Well, and this is kind of a perfect segue because that patience, and I don't know if you were taking notes, but if you were, then you noted a lot of things to sort of watch out for, pay attention to, advantages or forms that you might need or terms you might need to know. The same goes for other types of loans. When you go to a dealership, you're going to go rather, you're talking to me from a credit union. So I'm going to encourage you to get pre-approved from your financial institution of choice. So you will, just like you would call banks who have the best deals, banks who have the best closing costs, banks who have the best debt protection opportunities for your home, rather than go to dealerships, I would encourage you to go to your financial institution who has the best gap insurance, we'll talk about it, who has the, like, we'll talk about what gap insurance is and things like that, but who has the best auto lending. You'll do that same level of research and due diligence when buying a car. And buying a car is good practice for buying a home, doing that stair step. As Brittany mentioned, trying to achieve those traditional post-college milestones, we'll call it. When you get in a house, are you getting a new car for graduation? When you gonna have a baby? I don't know what that looks like for you and your family, but those traditional post-college milestones. You can be rushed by whatever social environment that you traditionally live in to try and achieve those things. Again, stair-stepping with a car and learning how to talk to your financial institution, what questions to ask is going to be a good start. So before I get too hard, go forward. Yeah.
I have a question. Yes. Is it always the responsibility of the buyer to pay for the inspection, or can you negotiate with the seller?
Great question. So no, you can always negotiate, and I always just do it. Negotiate. Don't be afraid. If the seller really is interested in selling their property, they'll negotiate with you. So all they can do is say no. So absolutely you can. Something I forgot to mention too on that is when there are interested party contribution limits, which that means seller credits. There are certain percentages they can't cross because you, depending on the loan type, you have to put a certain percent of your down payment down out of your own money, but the gift funds can be a part of your own money. Okay, so just there is a difference there. If you ever hear that, it's just kind of a guideline thing that lender per lender will tell you.
Last thing I'll mention about home buying, especially as a single individual who maybe had an uncomfortable credit past. TSHAC, TSAHC.org. That is where I personally found the grant that enabled me to purchase my first home. And what was really cool was that I was 3 months into my career at Education Credit Union many years ago, and I had come from an environment where I was making far below a living wage into a living wage, and in 3 months I was able to get a mortgage. So again, self-employment, they're going to go verify your income for your business the last couple of years. But that traditional path, you finding a good job that pays you well, where you can accommodate a budget and a monthly payment and have an emergency savings. My story is 3 months. Of course, that was in the before 4 times, but my story is 3 months. It can be done. Good credit score, for us, 620 or above, debt to income ratio 43% or below, and you can have that conversation with a mortgage lender, and you can be asking those questions.
I do want to mention one thing too. Investment property, all of this is the same thing for an investment property. Now you have to put 20% down.
There it is.
So I will say this because I've had these questions come up many times recently. You can actually use your rental income on the property as income to qualify if you're doing like a refi, if you're wanting to purchase a house and you already are renting it. And anyways, there's lots of ways, but you can use rental income for income on your purchase as well, even if you're buying another investment property. So that's a whole other ballgame. We're not going to get into that. But
Jen will be here in a couple of weeks. We'll talk about
Yes,
investment rental
investment.
properties in 2
She's
weeks.
the guru. Yeah.
There we go.
Great. Okay. Any other questions on mortgage that I didn't maybe touch on today that you're interested in knowing? Don't be shy. Yes.
I wonder what your thoughts are on refinancing.
So I would say owner financing, are we talking like, there's an example, so Blue Haven Homes, good question, this brings up 2 things. So Blue Haven Homes, for example, you rent from them, part of that rent each month will go towards your purchase of the home, that same home, so you're already living there. I would say it depends, just have to make sure all the paperwork's good.
Read your terms
Yes.
and conditions.
If you go through somebody like Blue Haven, okay, that's a bigger company, it's probably fine, but if you're doing an owner finance, remember, they still own that property and you're making the payment. So at any time, no matter what they've told you verbally, if you don't have something written and signed, you could be getting in trouble. So I would say I'm not opposed to it as long as you just kind of read the fine print and make sure you have it on paper.
I have a story for this, and it's entirely anecdotal, so take that for what it's worth, but it is a former team member. This person was a single parent raising 3 kids, and they were told by the person they were renting their house from, like, in 10 years, you pay me this much in rent for the next 10 years, and the house is yours, done. And they signed paperwork to indicate such. 8 years and 9 months in, that person wanted to move back into their home. And that single parent with 3 children had to find somewhere to live in 30 days. So, make sure you read your terms and conditions and that your paperwork is on the up and up. Find a lawyer friend, find a pre-law friend
Yes.
somewhere on campus. So, and make sure your stuff is on the up and up. But it is doable, but again, just make sure in that you're taken care of.
And there's a lot of ways that, I don't want to get too complicated because I'm a nerd for this kind of stuff, but there are ways like at ECU, let's say you either have a parent or a grandparent that has a house they want to gift you or give over to you. Okay, well technically you'd have to go and do a purchase, right? You'd have to purchase it from them. Let's say they're not going to transfer the deed, they want you to buy it. I can do, it's not technically a reverse mortgage, but that's how we label it. So I can actually do kind of a backwards purchase to where they would sign the deed at the closing table to actually make you in title. And then I would turn around and do a refinance for you because now you're pulling out money to pay them back for buying the house, but you're doing it as a refi, a home equity, instead of a purchase. I know that sounds absolutely insane, but I can do it. So
You got me confused.
I know. It's got to be in between family or somebody that was willing to do it for you. But basically, they transfer the deed, which means you're now owner of that house and you can do a refi. So the money that you pull from that, you're paying back to them. So it's almost like you purchased the house in cash, and now you have a cheaper closing cost and a cheaper payment over here because you did a refi versus a purchase. Come see me. I'll tell you more later.
Do you have to, like, my family has given me their cars for like $1. Is that different with the house because of the legality of it?
Yeah, it's a little bit different. So again, it all is case by case. Come see me and I'll answer.
There we go. Make sure all the paperwork is correct.
Yes. Okay. Anything else on mortgage before we move on? Okay.
And really quickly, and I mean, so you've gotten a lot of mortgage help and a lot of mortgage questions answered. If you can buy a house, you can certainly. Again, it's the same essential principle: evaluating, do you need it, do you want it? Asking your lender questions, getting pre-approved from your financial institution. You're going to look and say, hey, you qualify for a $30,000 car. Do you need to go buy a $30,000 car?
No.
Yes.
No.
So, but letting you know the ceiling, and then again, adjusting your budget, finding the interest rate that best. Call around. And calling around for auto insurance rates is perfectly normal. Again, I would suggest you go to their website first, because we're gonna show rates as low as. So last week, when we talked about perfect credit scores, rates as low as is that section on our website that tells you what we're gonna charge you. And so look there, and that's a good indicator of how much it's going to be for you. Even if you don't have A+ credit, you're going to still know who's gonna charge you. So that's a good starting point. And then recognize what products they have. One of the reasons we encourage people to talk to their lender rather than going to a dealership is because your lender is going to provide things like gap insurance. Who knows really quickly what gap insurance is? Very good. So for the rest of us, it's guaranteed asset protection. That's what GAP actually stands for. It's guaranteed asset protection. Everybody knows that whenever your car drives off the lot, it instantly depreciates in value, instantly. So it's never worth as much as what you originally signed papers saying you're going to pay for it. If you get into a wreck and the insurance company is going to pay you $15,000 because that's what the car is worth, but you still owe $20,000 on this car, you have $5,000 in an undrivable. You have a $5,000 bill in an undrivable car. Gap insurance takes that $5,000 to zero. It fills the gap. And so that's essentially how that works. Your lender, your bank, your credit union has gap insurance for their auto loans. Ours is the cheapest in the Panhandle of Texas. But I encourage you to, again, your dealership will also have those products. Dealerships, our products scale down. That's one of the things that makes it cheaper. So the more you pay on your car, the less your gap insurance is per month. It's like $4 anyway. So it gets less and less and less, and then eventually it goes away once you paid off the loan. Dealership insurance generally doesn't scale downward. Other lenders may not scale theirs down. In-house perks. I'm thinking we have to get a quiz. Really quickly for the in-house perks. Your lender, your financial institution, just like Brittany mentioned our loan modifications earlier for like a home, your lender has the same thing sort of for a car. So we have our skip a pay program. So your dealership is not going to let you skip a car payment. That's just not going to be a thing that happens for them. But your financial institution, like us, we do have what's called skip a page, where if you've made your payment for 6 months at least, you then in month 7, if you need to, or month 12, or month 36 of your loan, whatever that looks like, if you've made on-time payments for that duration, you can pay $1 or $25 and skip that month's car payment. So like Christmas getting tight and you don't want the $520 going out for your car, well then you can pay $25 instead of $520. And it extends the life of your loan for that month, but you also, it doesn't hurt your credit, you don't have that bill, that kind of deal.
Or you're short in escrow and you need to put $500 in your escrow account, go skip a payment and put that in your escrow.
There are lots of things you can
And you
do.
cannot skip a payment on mortgage. I'm so sorry.
Yeah, you can. It's only for certain.
Just for other loans.
But, and again, that may be for us, but your bank, A&B, Happy, whoever, they might have, get the payment options more. I don't know, I don't work there. But that's the thing, is you have options with the person you built a relationship with. Again, we've talked, so much of this is about building a relationship with whoever is handling your money. These people are going to hold your savings for your retirement. These people are going to get you your loan for your home and for your car, and make sure you have a good credit card product, and make sure your kids get braces, and whatever that looks like for you. Be comfortable talking to them, and be comfortable, again, asking hard questions or confusing questions. Yep. Now, who's ready for a quiz and the opportunity to win $50? 2 separate things. There we go. Very good. All right, so quiz time.
Just so you guys know, we do offer I-10 lending now too. So
Absolutely, that I did.
That's new. Not for mortgages yet, but we do have I-10 lending if you guys need it.
Yes. So I did forget. I did neglect to mention this last time in previous.
Help in Spanish if you need that.
Absolutely, yes. Brittany also does speak Spanish. Fun stuff. Will you closing? But yes. So Kahoot, for those on the board, and while y'all are getting logged in, we do I-10 lending. I-10 stands for International Tax Identification. Not teller. I'm not.
I'm like, nope.
Our International Tax Identification Number. And so for those people who don't have a Social Security number, who have moved here internationally, I-10, most people to open up a financial account at a bank or federally insured bank or credit union have to have a Social Security number. Some institutions offer people accounts with I-10s. We are one of those institutions. A few of those institutions offer loans to people with international tax identification numbers. We are one of those institutions. Those are up, right? Yes. Top 3. We'll drop this out.
Yes.
If I can comfortably pay cash for my vehicles, is it worth it to take a loan out to build credit, or is it depends?
So financial coach me is gonna ask you, what do you wanna build credit for? Presumably to buy a home.
Yeah.
Okay, so I would time it with that in mind. Like, get your car loan, pay on it for a handful of months, 6
I would say
months.
6
Yeah.
months.
Exactly, just to demonstrate consistency in the area, you have people handling a large amount of debt, and then pay it off, with your credit. After we've initiated the home buying process, that's my question. Is
We didn't
because-
touch on that too, real quick, sorry, this is important. So if you've started a loan application somewhere, it's very important that you do not go get new debt. Don't rack up your debt, and you cannot pay cash at the closing table. So you have to have it in an account, it cannot be cash. Anyways, so,
That was good to know. But yeah, basically, yeah, get it, pay it off, and then once you're approved,
Yep.
the loan, move on.
When you say cash,
so if you pull out
a
$20,000.
briefcase or did
Yeah.
you
Yeah.
like a cashier's
Yeah.
check?
Do you know how many drug lords would also be landlords?
Yes.
Okay, so like.
You
that's
can
what-
bring me a
Are you
cashier's
sure there aren't? That's my question.
You can do a cashier's check, absolutely, from your account. But that money, so I'm gonna look at the last 2 months of bank statements or whatever asset statements we're using. And if you've made a large deposit, which is 50% more of your monthly income, okay? It actually depends on what loan type, but anyways, there's a number that we look at. It's considered a large deposit, we have to source it, and if it's sourced to cash, you cannot use it. So I would have to back it out, and you would potentially be short funds to close, and you'd have to go call Grant and say, can you give me money?
Well, yeah.
And there's ways around it. I'm not gonna tell you my tricks, but
There are ways.
Not- just come to me.
Yeah.
Nothing illegal. Just saying.
Like,
Are we ready?
we have 24 in. Is everybody in who wants to be in? Just get some easy
Hope y'all
swag.
listen.
Some chapstick, I think. And a timer. Our brain gauge is